I'm going to compare fixed rate mortgages with variable rate mortgages in Canada by walking you through some of the key differences and explaining some of the factors that affect the mortgage rates you can get. Honestly, some of it can be a little confusing, so if you're wondering if you should go with a fixed rate or a variable rate, you don't want to miss this one. My name's Trevor Tardif, and I'm a realtor with Century 21 Masters. And if you'd like more tips for buying and selling real estate in Edmonton, Alberta, make sure to subscribe and click that little notification bell, and then you'll get notified whenever I post a new video. And if you're seeing value in this video, give it a thumbs up. It really makes a huge difference. And all the links I mentioned in this video are in the description box below. Are you interested in getting a reference guide with all the key takeaways from this video? Well, you're in luck because we put together a PDF cheat sheet called Comparing Fixed or Variable Rates. You can grab your free copy with a link in the description below. All right, so let's jump into it. When buying or refinancing a home, one of the key decisions you'll have to make is whether you go with a variable or fixed rate. So what's the difference and how do you pick? First things first, how do lenders set interest rates? It's a little complex, but there are several factors that determine your interest rate, like the length of your mortgage term, the current bank prime rate, and the bank's posted and discounted rates. Other factors, like if you choose a fixed or variable rate, more on this in a moment, your credit history, and if you're an employee or self-employed, will also impact your rate. Okay, so that was a bunch of words and terms that might be confusing or meaningless to you if you aren't already pretty familiar with this stuff. So I'm going to quickly give you more context and define a few terms to help you understand how some of these things affect your interest rate. A mortgage term is the length of time your mortgage contract is in effect. When you're coming to the end of your mortgage term, you can either renew your mortgage with the same lender or refinance with another lender. Most mortgage holders in Canada have a mortgage term of 5 years or less. The reason your mortgage term affects your interest rate is because lenders normally offer different rates for different mortgage term lengths. The interest rate typically increases as the term length increases. Prime interest rates are influenced by what's called the target for the overnight rate set by the Bank of Canada. And when the Bank of Canada raises the overnight rate, it becomes more expensive for lenders to borrow money, so lenders raise their prime rates to cover the cost. The same happens when the Bank of Canada lowers the overnight rate. Lenders usually lower their rates by the same amount. Prime rates are the rates banks and lenders use to determine the interest rates for variable rate mortgages. Prime rates in Canada are currently 2.45% across the board with all the major banks as of the posting of this video. And it's been sitting at 2.45% since March 31st, 2020. This could change soon though, since the Bank of Canada is implying overnight rates will be increased sometime in 2022. Bank posted rates are the publicly listed mortgage rates of the big banks and are essentially like the sticker price on a car. The banks also usually advertise discount rates, which are closer to the rate the bank will actually offer you. Posted and discount rates are referring to fixed rate mortgages. Okay. So what's the difference between a fixed rate and a variable rate mortgage? When you opt for a fixed rate mortgage, the interest rate negotiated for your mortgage will remain the same until your renewal, which is usually within 5 years. This means that whether interest rates go up or down, yours will stay the same. Keep in mind that breaking a fixed term mortgage will result in higher penalty fees because the penalty is calculated based on the interest rate differential or 3 months interest, whichever is greater. Whereas in a variable rate mortgage, the interest rate will fluctuate according to the prime rate until your renewal. There are two options for these types of mortgages. You can have a variable interest rate mortgage where the interest portion of your monthly payments fluctuates according to the prime rate. This would mean that your monthly payments would change every month, but the amount you pay towards your principal will remain the same. The second option is a variable rate mortgage with fixed payments, where your monthly payment remains the same every month regardless of the rate changes. However, the amount from your monthly payment that goes towards your principal will change based on whether interest rates increased or decreased. In this case, if interest rates increase, the amount that goes towards your principal will be reduced and the amount towards interest will increase according to the new higher interest rate. The opposite happens if interest rates decrease. The amount towards your principal increases and the amount towards your interest payments is reduced based on the new lower interest rate. Pros and cons of a variable rate mortgage. Pros. variable interest rates tend to be lower than fixed interest rates. They could be less expensive over the mortgage term. The penalty for breaking a variable rate mortgage is usually lower than fixed rates. Cons of a variable rate mortgage. You are at the mercy of the prime rate fluctuations. While the rate could go down and potentially save you money, it could also go up, leaving you with a significantly higher mortgage payment or a very small contribution towards your principal. Potential uncertainty. Risk of the potential financial burden if rates increase. Pros and cons of a fixed rate mortgage. Pros. Your monthly payments will remain the same. Predictability, since you know what to expect every month. Cons of a fixed rate mortgage. Interest rates are usually higher than variable mortgage rates. The penalty for early repayment can be significantly higher than variable rates. Now, how do you pick between the two? Fixed interest rate mortgages are the most common. They also tend to be more popular with younger age groups, whereas variable rate mortgages tend to be more popular with older age groups. That being said, fixed rate mortgages are still the majority. Something to consider are your plans for the property. If you're planning to refinance the property or sell it soon, go with a variable rate. It will save you money on penalty fees since breaking a fixed rate mortgage is typically more expensive. If you're thinking of selling soon and are not too comfortable with a variable or want a fixed rate for whatever reason, opt for a shorter term, like 1 or 2 years. Keep in mind the difference between the fixed rate and the variable rate. If the difference is significant, you may do better taking advantage of the lower interest rates that the variable rate offers, even with the fluctuations in interest rates. Your comfort level with uncertainty is another important factor to think about. While over the long term, going for a variable rate will likely save you money, if you know you will be stressing over fluctuating monthly payments or a fluctuating pay down of your principal, you may be better off with a fixed rate. All right, as a little bonus, here are a couple of mortgage hacks. Number 1, always pick variable but pay fixed rate mortgage amounts. Using this strategy means picking the lower variable interest rate, but increasing your monthly payments to what you would have paid if you had gone for a higher fixed rate. Not only will you get used to paying a higher amount in case interest rates increase, but the extra amount will go straight to your principal pay down. This will carry a compounding effect on your mortgage balance and interest savings over time. Number 2, take advantage of the mortgage prepayment amount to minimize mortgage penalties. Since mortgage penalties are calculated based on their outstanding amounts, making prepayments on your mortgage can minimize the penalty you would otherwise get if you break the mortgage. While this is not always possible and wouldn't completely eliminate your mortgage penalty, it's a good idea to take advantage of prepayment amounts when you're in that situation and you have the financial flexibility to pull it off. If you're interested in getting a reference guide with all the key takeaways from this video, we put together a PDF cheat sheet, which is linked on screen now, called Comparing Fixed or Variable Rates. You can grab your free copy with the link on the screen or in the description below. And I'll see you on the next video.